The Dow Jones Industrial Average fell 562 points today, its worst single-day drop since the June 23 semiconductor crash. The S&P 500 lost 0.32% after being down more than 1% at its low, and the Nasdaq Composite closed basically flat, up 0.05% after recovering from an intraday decline of 1.3%. Three different indices, three different stories, and both of the day's defining events, a collapsed ceasefire with Iran, and the first FOMC minutes of the Kevin Warsh era, played out in a way that forced the market to bifurcate rather than break. Welcome to Market Lens. I am Daniel Reed. Today is July 8th, 2026. This is the end-of-day edition, and I am going to show you why today matters more than the headline numbers suggest. Let me start with the numbers that frame the session. The Dow closed at 52,327.23, down 1.07%. At its low, it was down more than 650 points. The S&P 500 settled at 7,479.75, down 24 points from Tuesday's close, but well above the session low of 7,435. The Nasdaq Composite finished at 25,830.66, up about 12 points. The VIX climbed to 16.57, a 2.7% increase, but well below the 19.50 panic spike we saw on June 23rd. West Texas Intermediate crude surged as high as $76 a barrel in overnight trading after Iran attacked 3 tankers in the Strait of Hormuz, and the United States struck Iranian targets in response. By the U.S. equity close, oil had given back most of that move and settled near $72.48, up roughly 0.4% on the day. Gold gained 0.6% to $4,127 an ounce. The 10-year Treasury yield rose to 4.50%, a 2-week high, driven by the initial oil spike. Now let me walk through the two catalysts in the order they hit the tape, because the sequencing matters for understanding where we go from here. Catalyst 1 hit before most of the U.S. market woke up. President Donald Trump, speaking at the NATO summit in Ankara, Turkey, said the interim ceasefire agreement with Iran was over. That statement followed an overnight exchange of strikes. Iran fired on 3 commercial vessels near the Strait of Hormuz, and U.S. Central Command struck Iranian military targets in response. Oil surged immediately. Brent crude touched $76 a barrel in after-hours trading. The energy complex opened with a 5% gap higher. But here's what happened next. By 3:30 a.m. Eastern, the war premium had started to bleed out. By the U.S. cash open at 9:30, WTI crude was trading at $72.48. The entire escalation from ceasefire collapse to kinetic exchange to price discovery happened in roughly 6 hours, and the market ended the day almost exactly where it started on oil. The 10-year yield held at 4.50%, up a few basis points on the oil bid, but the Treasury market did not panic. Gold added $26. The VIX barely budged from levels that were already elevated by the Samsung sell-off on Tuesday. The message is that the market has now seen enough cycles of Iran escalation and de-escalation to stop treating every headline as a structural shift. The Hormuz premium is being priced out because the pattern has not changed. Missiles fly, oil spikes, diplomacy resumes, oil falls. The 7th cycle is following the same script as the first 6. Catalyst 2 was the FOMC minutes from the June 16th to 17th meeting, released at 2 p.m. Eastern. This was the first set of minutes from Chair Kevin Warsh's tenure, and the stakes were higher than a typical mid-cycle minutes release because Warsh deliberately created an information vacuum at the meeting itself. Here is what we learned from the minutes. First, the Federal Reserve is more united than the market feared. Despite the 9-to-9 split in the dot plot, 9 participants projecting at least 1 hike this year, 8 projecting no change, and 1 projecting a cut, the minutes showed broad agreement on the fundamental outlook. The committee viewed current inflation as supply-driven and potentially temporary, a dovish framing that was endorsed across the table. There was no factional war. Warsh described the meeting as a family fight in his press conference. But the minutes show the family agreed on more than it disagreed on. Second, the committee's concern about inflation is real, but conditional. The minutes specifically cited 3 sources of upward price pressure: the Iran-driven energy shock, tariff pass-through from the ongoing trade realignment, and AI-related capital expenditure adding near-term demand without an immediate supply-side payoff. But the discussion did not treat any of these as structural. The language framed them as monitorable risks rather than entrenched problems. Third, and most important for traders, Warsh's abstention from the dot plot was not a signal of division. It was a signal of process. He told the committee he would not submit a projection because he believes the SEP constrains policy flexibility. And he used the meeting to announce 5 task forces to review Fed communications, the balance sheet, data sources, productivity and jobs, and inflation frameworks. The minutes confirm that the committee accepted this approximation. Without conflict. The silence was strategic, not contested. The market read this as slightly less hawkish than expected. The S&P 500 was down roughly 1% before the release. It recovered to close down only 0.3%. The Nasdaq flipped positive. The initial reaction in bonds was muted. The 2-year yield did not move. The 10-year held at 4.50%. Rate hike probabilities shifted modestly lower. The implied probability of a hike at the July 28th to 29th meeting held around 24%. September odds ticked up slightly to about 50%, but that was driven more by the oil spike than the minutes themselves. Now let me talk about the divergence that defined the session, because it is the single most important takeaway for common traders. The Dow fell 562 points, while the Nasdaq finished flat. That is not a typical rotation. That is a bifurcation. Capital did not move from one sector to another. It moved out of the sectors that are most exposed to higher oil prices and higher rates. Industrials, financials, transportation, and stayed in the sectors that have their own compounding stories. Technology and energy were the only sectors that finished positive on the day. Nvidia gained 3.95%. Broadcom added 5% on top of the custom Apple chip deal extension announced earlier this week. Chevron and ConocoPhillips each gained roughly 1 to 1.5% as the oil bids supported energy. Meanwhile, Intel fell 2.4%. SpaceX dropped 2.6%. The Dow components that are most sensitive to an oil-driven demand shock got hit the hardest. What today tells you is that the market has stopped treating AI and energy as competing trades. It is treating them as parallel trades. AI semis bounced back from Tuesday's Samsung-led sell-off because the FOMC minutes removed the hawkish overhang that was suppressing the growth narrative. Energy held because the geopolitical premium is not dead, even if it is shrinking. Everything else got sold because the cost of capital is not falling and the cost of oil is not staying below $70. Here is the actionable framework for the next 48 hours. First, the Iran cycle is becoming tradable. The round trip today was the fastest yet. If you are holding energy positions, the exit window is shortening. The market is pricing that Hormuz risk is decaying with each cycle, not escalating. Second, the FOMC minutes confirm that Warsh is not a hawkish bomb thrower. He is a structural reformer. The committee is united. The dot plot was a one-off split that looks less significant in context. That is incrementally positive for duration-sensitive assets and for growth stocks that were pricing a worst-case rate scenario. Third, the Samsung sell the news pattern is sector-specific, not market-wide. Memory chips repriced because capacity expansion was announced. The AI infrastructure names, NVIDIA, Broadcom, the fabless designers, are not facing the same supply-side overhang. The bounce in NVDA and AVGO today confirms that the market is discriminating between pockets of excess and pockets of genuine demand. Fourth, earnings season gets real tomorrow. PepsiCo reports before the open on Thursday. Delta Airlines reports Friday. SK Hynix begins trading on the Nasdaq Friday in what is still on track to be the largest U.S. listing of the year, despite the memory sector sell-off. PepsiCo is the first real consumer health check. Delta is the first travel demand read-through. SK Hynix is the first post-Samsung test of whether U.S. investors still want memory exposure. Here are the levels that matter. The S&P 500 has support at 7,350. The level that held on June 23rd and again today at the intraday low of 7,435. Resistance is at 7,550. We closed at 7,479 in the middle of the range. The Dow has support at 52,000, the level that held during the June 23rd sell-off, and resistance at 53,100, the intraday high from Tuesday. We closed at 52,327, closer to support than resistance. The Nasdaq has support at 25,800. Which held today, and resistance at 26,400. The bottom line is this. Today looked like a panic on the surface. The Dow lost 562 points. The headlines were filled with strikes, ceasefire collapses, and hawkish Fed speculation. But underneath the surface, the market absorbed a kinetic exchange between the US and Iran in 6 hours, received a Fed minutes release that was less hawkish than feared, and delivered a split decision that tells you the structural thesis is intact. The AI trade is not broken. The rotation is real, but not uniform. And the FOMC under Warsh is not going to surprise you with a hike unless the data forces it. The question for the rest of the week is whether PepsiCo's consumer reads and Delta's travel demand confirm the soft landing or start to question it. I am Daniel Reed. Keep your data sharp and your logic sharper.